Not just corporates were facing a liquidity crunch, but there are many outfits in the stock markets that have been actually raising the big question. How do we get an idea that gets the money back onto the street? Well, bonds have been an interim answer, as the bond market rally has managed to get a slew of bond funds on the launch. But our correspondent Deepika Taplayal tries to find out if this party is going to last and whether really the mutual fund industry will have any good time in the medium term.
The mutual fund industry is back on its feet following the carnage in October, with average assets under management growing for the second straight month, up by 9.5% in January. And the biggest drivers have been debt funds, benefiting from a jittery equity market and higher returns generated by falling yields.
The growth will come on the fixed income side of the schemes.
However, there are fears that major part of the bond market rally may be behind us, as a slower pace of monetary easing and a widening fiscal deficit could be prospective party poopers, as is evident from short-term returns of debt funds.
This major apprehension and a pronounced fact is a higher government borrowing due to a higher fiscal deficits, due to which the yields which we had seen going to lows of 4.86%, 10-year benchmark falling to 4.86%, had risen in a month's time to almost 5.8, 5.9 levels.
Fund managers believe that the quality of paper that debt funds invest in will remain key.
We have to guard against too much of enthusiasm and exuberance in the debt schemes, which means we have to be very careful about the type of schemes, type of securities, the companies, the credit rating of those companies where we are investing.
There is no doubt debt funds will continue to be frontrunners of growth in the mutual fund industry. But just a word of caution. Investors must not underestimate the risk associated with them. In Mumbai, Deepika Taplayal for NDTV Profit.